Hello, everyone. Welcome back to another episode of the GSD Show. I am your host, Mike Arce. And in today's episode, we're actually live on stage at GSDCon Money with John Briggs, the founder and CEO of Incite Tax. And today we're going to talk about the 10 most common financial mistakes in the fitness industry. For those of you that don't know, John has years of experience in the financial and accounting world, and his company Incite Tax works specifically with small business owners in the fitness industry. And he's going to be sharing the most common mistakes so that you don't have to make the same mistakes that cost other gyms thousands of dollars. And if you're interested in working with John, you get actually a special promo by going to incitetax.com/loudrumor. Again, that's incitetax.com/loudrumor. And if you're interested in coming to our next GSDCon event, just go to gsdcon.com to learn more. All right, let's dive in. John, we're preparing is 10 mistakes that you see that are common in this industry that we can talk about today, hoping that that information allows them to avoid it. Yes?
Yes.
All right. You guys want to hear 10 mistakes you don't want to make? All right, sounds good. All right, John, what's number one?
Number one, ignoring cash flow. Shocker, I know.
So what do you mean by that?
Oftentimes, gym owners create their gym because they're passionate about helping people get fit, saving their lives through health. And people usually, even all gym owners except the weirdo accountants, most people don't like numbers. And so they don't want to focus on it because it's not enjoyable. And it's hard because they didn't spend the time to learn the language.
So, I think where a lot of people spend a lot of time is that P&L. So they see their top line revenue, they see their expenses, and they see net profit. Help us just get really clear on the difference between net profit and cash flow.
Okay. So cash flow is we're talking about actual cash coming into the business and actual cash leaving the business for whatever reason. And sometimes those are showing up on my balance sheet, not on my profit and loss statement. When I buy equipment, for example, that doesn't show up on my profit and loss statement, but it is actual cash flow that left. If I took money out and I have a loan, the principal amount that I'm paying off towards my loan doesn't show up on my profit and loss statement. So we do want to focus on cash flow. Our financial statements help us do that. In fact, we often talk about profit and loss and balance sheet, but there's a third financial statement, and it's called your statement of cash flows. And if you're using a system like QuickBooks, it will produce it for you. You just run the report and you can look at it.
So when we're talking about cash flow in QuickBooks, how many of you guys use QuickBooks? How many of you use something else? It's like zero? Yeah? Okay. You know if cash flow statement's got to be in there, right?
Zero's not as strong with reporting,
Okay.
So I don't know if Zero has it or not.
Okay, so when we go into QuickBooks, we can hit cash flow statement, and is it going to be able to give it out to us on a monthly basis, like a P&L? Can I see it in a quarterly, an annual? Can I see a rolling?
You're normally going to look at it kind of like the balance sheet in a snapshot scenario. You can do a compare to prior period type of thing.
So when it comes to a business, let's say we're doing $50,000 a month, and let's say we're targeting about 20% net profit. We're doing $10,000 in profit. What type of cash, and I know it depends on the stage in the business, right? But let's say we're established, we're 2 years into the business. What are we looking at? What's a healthy cash flow for a business like that?
If your net income is 20% or higher, you're doing well. Most financially fit gyms are above that range. If you're under 10%, you're in trouble.
Under 10%, you're in trouble. There's a book called Simple Numbers, Big Profit, Straight Talk. You heard that one?
By Greg
Crabtree.
Yep.
He talks a little bit about that too, where he calls it life support. Anything under that, you're on life support, meaning you're like one thing away from being in some big trouble.
Yeah, we think break even, unfortunately, sometimes we think break even is zero, but the truth is with all the auxiliary expenses, we don't think about 10% really is your break even.
Got it. Number two,
leasing a larger space before necessary.
So leasing a larger space, meaning I have a location already, or I'm looking at getting one?
Both.
Okay.
So example, I was going to a CrossFit gym, and one of their classes out of the 12 that they offered during the day, one of them was at overcapacity, meaning they didn't have enough space to fill the one class.
Okay.
1 out of 12. So they decided to move from a 2,000 square foot facility to a 7,000 square foot facility because one class was at capacity. They negotiated 6 months of free rent in their new space.
That's nice.
Guess when they sold their business? Month 6. They were really smart enough to realize they weren't going to have the cash to pay for it. So it's about maximizing your current space as much as possible. And that's where I'm sure you guys come in with your efficiency rates and things like that. It is super critical.
And that's done by a couple of ways, guys. So number one, it's done by, okay, can we get more members in here? Number one, right? Like he said, one class was at capacity, but we have a lot of others that are still able to be filled up. What can we do to start really getting those spots filled up too? Who goes to those spots? But then number two is, can I do a price increase? Is there an opportunity for a price increase here? Number three is, what are the ancillary sales looking like? Number four is, do I have people in the top best programs? Can I find a way to actually move people up or ascend people up into a higher tier program? All of these are ways to squeeze more juice out of the lemon without having to go get another lemon. Does that make sense?
Yeah, and on top of that too, so that's like moving your existing location. But we see it as well as people maybe, oh, my first location's doing okay. I definitely need to open up a second location before they maximize the first. Without a thorough analysis, don't make that mistake. You need to understand, what is my actual cost going into the second location? Is it close enough as well that I'm going to cannibalize some of my existing members from my first location? Because then now I lost the revenue over here, and I was counting on that very thin margin to cover my expenses over here until I became profitable. So just always maximize the space of your current location before considering either moving to a bigger space or opening up a second location, because that step up in cost for the second location, it's larger than most people realize.
Well, you'll tend to notice a lot of franchises too, they go the opposite route. A lot of them, they start 5,000 square feet, and then eventually they end up bringing it down to like 2,000 to 4,000 square feet. Some of them like even less. So what they learn is, I can do a lot more with less and really squeeze more profit out if I didn't have to deal with a bigger space and all that comes along with it.
Yeah.
There's still ways to succeed with a bigger space, just so you know. It's not like you can't do it, but there's other ways to do it, and you can do it with a little space as well. It's number three.
Number three, pricing. Big mistake. And I'm going to talk about pricing from both sides of the argument. You know, the first one is, are you charging enough for a healthy margin? Right? Did you just base your price off of what the guy down the street's charging? Not the best pricing methodology. So healthy margins, you want to make sure you do that. And you can back into it. Like if I'm shooting for 20% net income, I can look at my profit and loss statement and my cash flow statement and determine, okay, this is the cash that goes into my SG&A. This is my margin on coaches. Therefore, I back into it. If I want the right margin, my price needs to be X. And you can back into it that way, and that's one way to make sure you're pricing the right way.
Can you say that one more time? I'm sorry.
Yeah, you're ultimately looking at all your expenses first. So what is my overhead or SG&A? What's my cost of goods sold or cost of service? So those are, I'm going to incorporate all my costs. What margin do I want? So in this case, if it's at least 20%, I would say shoot for more, why not? And then so you just kind of divide it by that ratio, and that gives you the number.
That's cost plus pricing. There's a lot of different styles of pricing that you can do. That's one of them, where you go, hey, what does it cost? And then how do I make margin above it based on the margin that I want to make? And then that usually gives you a base. Once you have a base, you can play around with other styles because you generally have an idea of what range you're going to be in. It's not like you're going to charge $220 a month and then 6 months later you're going to go to like $98 a month. Like, it's not going to happen. You're going to generally know, okay, this is where I need to play to reach some of my margins. But when it comes to pricing, it's not just charging more, it's also charging creatively as well. Because you can have a lower price option, but make the higher price option so damn appealing that this is the only one that people want to do. I think a lot of what you said, a lot of people do is they copy the neighbor. It's like cheating off somebody that you don't even know if they studied on the test, right? You don't know if they're winning. Based on the industry and based on what we see, the chances are they're not probably doing that well. But we're going to copy them because it kind of looks sensible, but it doesn't mean it's actually the most effective way to structure your pricing to get that buyer to make the best decision possible, not only for their desired outcome, but also for your profit.
And the other side of the coin, though, is, am I providing enough value to justify the price that I'm asking from the member? Like, we love this, let's raise prices, great. There is a point where your members will start thinking like, wait a minute, what am I getting for what I'm paying for? You know, franchise fees are kind of a similar scenario, right? Like, am I getting enough out of what, you know, I'm getting back? So just make sure you're balancing both ends. I think it's important. We sometimes overlook that, and I've seen some clients come in like, oh yeah, I'm going to start this program. I heard this guy is charging this much, so I'm going to charge $500 a month. Okay, what are you going to do different? Like, what are you adding? What's the value? No, I'm just going to charge $500 a month for the same thing that I'm currently doing.
Yeah.
And usually in those cases, it didn't work out.
Yeah, and you know, we've talked about that. I think I dive into it in my presentation tomorrow a little bit, but Apple's iPhone went up a lot since 2007 or whenever they came out. I have the dates on the slide, but it went up a lot. But when you look at it, it's not just inflation, because if it was just inflation, the price today would be $691 for a phone, based on what they charge. But they kept making the phone better. Cars keep making the phone better, and you see not a lot of franchises or independents are really working on making it better. They're finding ways to sell it better, and selling it better is good too. We got to work on both. I got to interview Cody yesterday. It was Cody. Cody's back there. I got to interview him yesterday. We were up on the stage doing our GSD episode. You got 700 members over there, right? At your kickboxing studio. Really cool. And I'm just like thinking about some of the stuff he's doing. And you know, he found a way to actually measure the punching power and the amount of punches in the bags. Like, you have sensors within the bags, and you didn't make it, but like you got it. And he's actually using that in reporting and data along with other things in order to show the progress that someone's making. Because not everybody is in it to lose weight. Not everyone's in it to get stronger or fit in jeans. Some people just want to see progress. We feel better knowing we're getting better. And if that's your client, that's your target, how do we show progress? Because if we don't show progress, it's easy for average people to not measure their own progress and then feel like nothing's changing, even though when they really look back, they're actually better, but they wouldn't ever know. So sometimes we're giving good value that is worth the cost, but because we're not able to demonstrate it, the perceived value is less than what it actually is. Does that make sense?
Yeah, I love that distinction. So next one is hiring too quickly. It doesn't just apply to you as the owner removing yourself and taking off some of the hats. It also applies to your other team members. I can tell you, managing my gym and my accounting company, I have dealt with 200 plus humans that I was responsible for their livelihood. And a lot of them always felt like they needed either more time to do things, which I didn't want them to work overtime, or they needed less things on their plate to get things done. Without systems to help you understand how efficient or how utilized somebody is, it's easy to take their word at it like, oh yeah, maybe I did put too much stuff on their plate, without any sort of metric. So have your metrics so that you know, is my team member actually doing enough, or are they just being lazy? And are they being lazy because they're lazy, or is it a training thing, I just need to train them? But sometimes we take their word for it and we hire the next person, and now I have like 3 or 4 people for something where only one person is needed.
Yeah. In all companies, and yours is going to be like this as well, great companies aren't run by great people. They're run by great systems, and those systems are run by great people. So sometimes you can waste a really great person that could do really good things for the company because you're not giving them the plays to be successful. You take some of the best, let's say some of the best basketball players in the world, and you put them against another group of players that isn't as good as them, but this group gets to use plays and these guys don't. They're making so much more out of each possession. They're wasting less energy because there's specific things involved, and so they're doing more with less. And these guys are doing less with more. And so systems are absolutely something that we need to respect as a business. Always asking, how can I do this faster? How can I do this cheaper? How can I do this more efficiently? How can I even make it easier for my people? Because, one thing with like certain people on the team, Patrick McKenna, I think there was something that happened over the last week or two where I was like, yeah, I get you can do it, but I don't know if the best thing is for you to do it. There's got to be a way we can either outsource this or get a software or get something, because I'd rather you do something that this cannot do.
Yeah, and to your example, I mean, if you follow the NBA, most people are going to put Michael Jordan as the best player or in that discussion. He was a lousy coach and a terrible owner for a franchise. He was not; those are not the right positions for him. So, yeah, sometimes you have a good person, they're just not in the right spot.
Right. Yeah, we talked about that on People Day, right? Get the right person in the right seats, doing the right things right. That's the goal. All right. Next.
Okay, inefficient inventory management. Your inventory is cash. You took cash from the bank and you converted it into something tangible that now sits on a shelf. And in order to get the cash back, hopefully at more cash than what you put into it, you need to sell it. We just see a lot of gym owners overbuy, whether it's supplements or apparel, and it just sits there on the shelf and it's just cash that literally, if it was put in a terrible CD earning a terrible interest rate, would have been better for them than just put it on the shelf. So know what your members want. I know that we all want our people wearing our logo and stuff, but sometimes spending $3,000 on apparel to hopefully sell it to people isn't maybe the best idea. And I know a lot of companies who make the actual supplements have really good programs now where they let you do the order first and then you buy it based on the order, and that kind of stuff works really well.
Yeah, and there's actually some really good people in the room that manage this very well. I know when I went over to the Collective does a ton of ancillary sales with both supplements, you have a smoothie bar, you've got apparel, you've got a lot of stuff, and you guys have a pretty good system for managing that inventory, correct? Yeah. Always an improvement.
Efficiency, that's the key, right?
Right. And being aware of it, right? Like what gets measured gets improved. And if we're not measuring it, we just keep going like, oh, people are going to love this. Meanwhile, you still got the last thing you thought people were going to love in the closet. It's an inefficient way of improving this process, right? I think the hot room here, Ash is back there. They do an excellent job of selling retail. I'm sure they can also help out as well. Hey everyone, pardon the interruption. If you're still listening, it's because you find this information valuable, like I do every time I talk to John. John and Incite Tax, they work with all of my gyms. I just feel better knowing that my accountant and bookkeeper really understand the industry. It makes me sleep better at night. And if you want to work with John and his team as well, just go to incitetax.com/loudrumor. Again, that's incitetax.com/loudrumor for a special deal.
So next one, bad books. Matt kind of talked about this. You got to make sure your transactions are consistent and accurate because bad info in equals bad decisions. And you want to use your financials to make decisions, so they got to be accurate, they got to be consistent in order for you to make actual good decisions off of them.
A lot of the people in this room, by nature, may not be that type. So I'm that way. If you ask me to create a spreadsheet, I'll do it. And it'll be the best spreadsheet. And for like a week and a half, I'm going to be perfect with it. And then around the 2-week mark, I skipped a day and didn't even realize I did. So I have to actually have someone on my team that is able to take it and run with it, because I can't run with it because that's not my strength. If someone doesn't have that necessarily, is there a strategy, is there a way they can get around to still make sure it gets done?
Yeah, I mean, it's leveraging other people who are good at it. And ultimately, if you went into business to be a gym owner, you didn't go into business to be an accountant. Although, she gave a great presentation and awesome. I won't try to steal her. Find people who are good at it, and with a profitable gym that has some healthy cash flow, you can leverage your money for someone else's expertise. So instead of, because even the best spreadsheet that maybe you guys could create, how long did it take you? How much of your time did you spend doing it? Was that worth the couple $100 a month type of thing to give that up to have an expert do it for you?
Yeah, because that was one of the things I wanted to say when I was watching Serena speak, because a lot of the stuff in there, everything she was saying was accurate. The challenge is I'm looking at it and I'm like, it's good for you all to know this information. It's not necessarily good for you all to know exactly how to do this on a regular basis. It's just good for you to know it so you can have intelligent conversations with your accountant or with your bookkeeper or with your team about how to get these done. And if, shit hits the fan, you can get in there too. But you shouldn't have to worry about taking the brunt and being like, okay, so now I got to go get all my assets. I got to do all this. No, you just have an idea as to what needs to be done. And then when you get with an accountant, whether it be somebody from John's company or the current one you're working with or whatever, you can say, hey, look, how are our assets broken up? Can I look at the balance sheet? Can you explain this to me a little bit? How are you doing it? What stands out to you? And little by little, you start connecting dots and you become fluent. Make sense?
Next, shiny object syndrome.
My favorite.
Impulse buying usually doesn't work, and buying without analysis also doesn't always work. I'll just give you an example from the time that I ran my gym, my general manager. I tweaked my back moving one of those movable squat racks, just picking up and moving it. Seems like the injuries happen on the dumbest things. Like that'd be like, oh yeah, I injured my back. I was riding a Bronco, and no, something stupid. So he's like, oh, we should buy one of those machines. I think it's called a Rhino machine, where I could still do squats, but I don't have to put pressure on my back. It somehow attaches like a belt.
To the hip.
Yeah, something like that.
Yep.
I'm like, oh, that sounds cool. How much are those? Like, I think they're like $3,000. Thinking, my gym wasn't profitable, right? Like $3,000.
The Rhino's not going to save you.
Yeah, and how many people injure their back on an annual basis that we can't find something else for them to do to exercise that doesn't involve the $3,000 machine? So that was one, and then the other one was, oh, we got to get pegboards so we can do pegboard racing. Like, okay, does that help me get members or keep members? Like, how many members are really dying for some sort of pegboard race and do a wall climb? And then I did make a call to my insurance agent. I'm like, what would happen if I did that? He's like, oh, your risk would go up and your premium would go up because usually that thin mat that you have at the bottom isn't actually going to support someone if they accidentally fall or they get fatigued. Especially in the fitness space, shiny objects are everywhere. And a lot of times, they're shiny objects, we call them that because they look super cool. Just do the analysis. Will it actually help you get members or keep members? Is there going to be an ROI? And usually that's enough to help avoid that.
I will tell you that it's funny, when you really follow the jelly beans back, almost all your decisions are leading back to how can I get more members, how can I keep them longer, or how can I get them to spend more with me? If you're like, well, no, some of them are around people and hiring the right people, why are you wanting to hire the right people? So they can give a good service. Why do you want to give a good service? So that they can help keep people, okay, I get it. Right? So all the decisions really eventually lead down to all my decisions need to help me get more customers, keep them for longer, or get them to spend more with me. And if you can't follow the jelly beans back, you may just be buying the Rhino machine because it kind of looks cool, but it may not actually produce the result that you want. Cool?
Next one, and Matt kind of already talked about this one, overlooking subscriptions. As part of the Profit First system, on your allocation day, when you're moving money from your income account to your other accounts, one of the other things that you do is you're going to look at your transactions from the last time period. Meaning, if I'm sitting down every week, I'm going to look at the transactions that hit my bank account and credit card statement just from the last week. So much more digestible to do it that way than to wait 12 months and then go back and look at 12 months of statement, because no one does that. But I can look at 7 days or 15 days. Identify, like usually that's when you're gonna see these subscriptions. You're like, wait a minute, what is that? Every time we do this with a client, one of two comments, if not both, happen. One is, I thought I canceled that. And the other one is, I have no idea what that is. Two good indicators that those are not expenses you need to keep going forward.
Yeah, and I'll tell you, if you have a subscription and you forgot you had it, and it's 30 months later, and you just realize you hadn't used it at all, and you go to complain to the company that, hey, I actually haven't been using this, whose fault is it that either A, you haven't been using it, or B, that you have continued to pay it? Whose fault is it? It's not the company's, right? It's not their job to look at your books. Their books looked good. right? So make sure that you guys are keeping an eye on it, because at the end of the day, you have full responsibility over your numbers, and the subscriptions are a big part of that. They'll pile up without even knowing them.
We had a new client. He leased a Bulldog floor cleaning machine, and his contract stipulated that when the term was up, he needed to call them and cancel the automatic payment. He's a new client to us, so he didn't do that. And we asked him, I said, I'm just reviewing your books. It seems like you've paid enough for this cleaning machine. What kind of term did you get? I think you got ripped off. And he went back and looked. He's like, yeah, I paid that off 2 years ago, or should have paid it off 2 years ago.
And the payments kept coming.
Payments kept coming.
What did it total out to? Do you remember?
$15,000.
Raise your hands if you could use 15 grand right now. I bet that guy could have too.
Yeah, look at your transactions. It's good.
So can I give everybody a homework assignment by the end of this month? Everybody go through every subscription that you have and make sure you're still using it. Can everyone commit to that? Raise hand if yes.
Okay,
What's
number
next?
9, living beyond your means. This comes in a couple ways. Not normally a problem with our gym owner clients. This one is more with other industries, but sometimes we just want to live high on the hog. And because we can fund stuff in our business and we're not paying attention to the credit card debt slowly getting more every month, we don't realize that we're funding our lifestyle on debt, which isn't a good idea. But the one thing, I kind of alluded to this already in my presentation, so I just want to reiterate. One way that gym owners live beyond their means is they're not aware of those personal expenses that we're writing off for tax purposes that go through the business. Just don't let those become invisible to you. As long as you're aware of them, usually you'll be fine with making sure, like, oh, okay, I spent $3,000 in expenses over here, I get it. We've had clients sometimes like, yeah, I don't have anything to show for anything. It's like, I mean, you're making pretty good money. And then we show them their books and the expenses that are really for them. Like one guy was like $5,000 a month. Like that's an extra $60,000. He was operating under a mindset that he was poor. But the reality is once we showed him, like, you're actually spending 60 grand out of your business that the business would never cover if you weren't the owner.
Yeah.
Add that to what you're taking home, and all of a sudden you're like, oh, I'm a 6-figure earner. And he just operated differently after that. It's the mindset shift. So don't let those become invisible.
Yeah. And guys, this is business. How many of you guys, if you got a good offer, would be okay with making a sale and selling your business if it came, like a really good number came to you? Yeah, it's awesome. Matt, you invest in a lot of businesses too. You have 2 different people. They both want to sell their business. Everything looks generally the same as far as from the outside goes. But then when you ask this person about their books, they go, oh yeah, no. The only thing I put on here is for the business. Whatever runs the business is what's on here. I keep everything separate. And this guy goes, oh, well, that was a family vacation, but we worked on the trip. Like, how much does that slow things down for you? Because now I'm really feeling like I have to look into things and I have to really dive in. And now it's almost time-wise, it's more effort than it's worth. Whereas this is like, cool, we can make a deal, right? Right. So depending on what your long-term goals are, understand that your actions should align with your long-term goals. If they don't align with your long-term goals, it might actually be affecting your goals, helping you today with things that aren't your goals, but affecting your actual goals.
Cool. And then number 10 is no plan for wealth creation outside of the business. You talked about it. Bryce talked about it. Look, use the healthy cash flow that you'll get from your business and invest it in other things. Diversify. It works. But without a plan, you're not going to do anything. Maybe you end up having a high cash balance. In fact, at the VIP lunch, we were talking about how some people really want to keep their money in their business accounts as low as possible because they want to use it on other things. So they're constantly paying attention to what's the safest number to have so that I can use all the other cash to do other things.
Is Julian in here? Julian, you just started working, right? Where do you work? Culver's. Good hamburger place. Julian, if you make $100, how much can you spend? 25%. And then what else? What happens to the other 75? Savings, and then what do you do with it eventually? What are you going to do with that money? He's actually looking at buying a car to sell it to make money off of the sale of the car. So he's finding ways, because right now investing that in an IRA is not going to help him, right? But he's going, okay, he's like researching what can I do with that money to help make more money. But he knows if something's going to cost him $100, it's actually going to cost him $400, or he's got to make $400 to buy it because he's only able to spend 100 of that 400. And that's the way I like to operate too. Like, I want to live off a small percentage of my income. If I can afford this car based on the amount I have in my account, that's irrelevant to me. If I can afford this car based on it being 25% of my earnings, then I can work with that, because 75% is not mine, that's my future's. My future's going to want shit too. So I'm going to give myself today what I've earned today, and I'm going to give my future something else. Make sense? By the way, those are my numbers. You don't have to do it that way. That's Julian's numbers. You do whatever works for you. But I'm just sharing what works for me. All right, guys, was this helpful? Yeah? Big round of applause for John Briggs, everybody.
Hope you enjoyed today's episode. Once again, if you want to work with John in Incite Tax like he does with all of my gyms, just go to incitetax.com/loudrumor. Again, that's incitetax.com/loudrumor. Thanks for watching. We'll see you next time.